All right, good morning, everybody. We are here for BAM Education and welcoming Joe from Ross Mortgage, who has been extremely helpful in coming in and presenting on the different types of things that we might encounter as far as working with appraisals and the different loan types. He's also going to give us some information on new things going on with FHA and all of the different I guess, what would you call it, Joe? The different changes in your credit score and interest rates and all that, right?
Yeah, so one thing in our industry that's always the same is there's always change, and they're always trying to tweak stuff and make it better and sometimes worse, depending on which side of the coin you're on for what they change. So I'm going to try and go through and update you guys for some stuff that's going to be coming up in the market, so you are prepared for what's going to come through. Because as I get into it, this will make a bit more sense. But there's some changes on my end that will affect the real estate side very, very much so in the near future.
Perfect.
Yep. Let me see if I can get my screen shared. I see Angie jumped in. Hi, Angie. Let me see here. All right. All right. By a thumbs up, or if you guys can actually unmute yourselves, can you see my actual screen with slideshow on there from the PowerPoint?
Yes.
Perfect. Then I will bring myself down. So as we stated, I am Joey, the mortgage guy. I'm with Ross Mortgage. I specialize in doing VA loans. That's what I'm known for. But I've branded myself so well that people think I only do VA loans. I actually do all of them. And as you go through this presentation, you'll see that. If you have questions, things that we don't know, or things that don't make sense, please let me know. The slide deck has been provided already for PowerPoint. So it's printed out as a PDF. If you haven't received it at the end of it, if you want a copy, just let us know. We'll get you a copy out there. And my contact information is at the end if you have any other questions. So who am I, right? So my name is Joe Iremescu. I've been doing mortgages for about 20 years. I'm originally from Michigan. I moved to Florida. It'll be 4 years, July 3rd of this year. I specialize in doing VA loans, which is why I'm on the Veteran Mortgage Advisors Instructor. Military Mortgage Boot Camp. I'm a branch manager. I run in multiple states, and I do a lot of teaching and education. That's my actual passion. I don't wake up in the morning on fire to do math, right? I like helping people get better at what they do, specifically helping agents get better and make more money, because it helps me do what I do best. So one of the things I want to talk to you guys about is FHA. If anyone has seen any videos out there about the industry, you've heard about LLPAs, or loan level pricing adjustments. In plain English, this just means that the government changed how loans are actually structured cost-wise. So if you look on the screen, there's a whole lot of numbers and a whole lot of colors, but here's the takeaway. If you look in the bottom left-hand corner and then you go over to the right, you'll see that's the lower credit scores. And as you go farther to the right, that is actually the lower down payments. So all the things that are green or yellow either didn't change, or if it's green, it actually got better for those people. Now, if you notice, those are all people that have low credit scores and low down payments. And if you look above where it's changed to red, those are people that have good credit scores and large down payments. What the government essentially did is they made it less expensive for people that have bad credit and a little bit of money to put down and not a lot. They made it less expensive to try and bring more buyers to the market. All right. And they made it more expensive on the people that actually save their money, have good credit, and qualified. They're essentially subsidizing those amounts that are being paid at the end of the day for what's called loan level pricing adjustments. So those change across the board all the time, but this is a major one they came out with. So the reason I'm showing you that is this. The FHA changed another thing also. Mortgage insurance premium. For those who don't know what that is, you've heard of PMI. MIP is just FHA's version of that. They changed that also along with these LLPAs. So if you look in the bottom right-hand corner, highlighted in yellow, you'll see the 95% loan to value or greater. It used to be 0.85%. So what does this mean in plain English? When you buy a home, if you have less than 20% down on a mortgage, you're going to pay mortgage insurance. This is what that was. It used to be 0.85. If you look in the upper right-hand side, they lowered it to 0.55. So it doesn't seem like a large difference, but if you look on the far left-hand side, you'll see that this is for a $250,000 purchase with a $241,250 mortgage. Now, if you look, as you scroll down, you'll see the monthly MI cost. It's $108. That's the new monthly MI cost if you were to buy today. The reason this is important is because it saves you about $63 a month on a $250,000 purchase. If you go to 500, that number is going to more than double. So you'll see the old rate was 0.85, the new is 0.55. So the reason I'm talking about all this is that the government is trying to make it so that people who are less qualified and have lower credit scores and lower down payments can buy homes. So on the real estate side, what that means in plain English is you're going to see a lot more FHA offers coming to market, which is why I wanted to go over FHA first and how it actually functions. So here is direct from an appraiser that does FHA appraisals daily, what they actually look for and what to look out for on your own. The number one thing that pops up on FHAs for getting flagged for issues is chipping, peeling, flaking paint, right? And also lead-based paint. Those are some of the biggest ones that we see out there. So if the paint was prior to 1978, chances are it had lead in it, and you'll have to do some stuff around that if there is lead. If it's after 1978, you're probably okay to just get it scraped off and repainted, and you'll be okay. The next biggest one that you see is electrical outlets, right? We've got to have cover plates on them, and you usually have to have ground fault interrupters in there. Another simple one, the toilets must flush and be mounted. And if there's an active termite infestation, they need to make sure that's cured, right? We have to remediate that. Also, the water heater has to be in working order and up to local code. As we go through these different options of different loan programs that you're going to see, they all carry the same thing. The things have to function. It has to be safe, sanitary, sound. It's a combination of those things. FHA is no different, right? Next items, minor cosmetic issues like stained carpet and interior paint are okay. They don't have to be perfect, but if it's going to affect the health and safety, and you'll hear that a lot, or the economic viability of the program, then the house has to be fixed up. So one thing that we see, windows that don't open or close or are painted shut, or if there's cracks or broken windows, you cannot use them if they are painted shut or broken. If there's minor cracks and it's not a safety issue, you can use it. So as your appraiser's going around the home and you guys look at the home with your clients as you're going to walk them in as a buyer or as a seller, and you see that there is a cracked window or a broken window or a pane of glass hanging out, that's a safety issue. Somebody could hurt themselves on it. It will immediately get flagged by the FHA appraiser and it has to get fixed at the end of the day. Same thing with paint, like we talked about before. If you're walking through the home and you see dangling wires or exposed wires, or you see a socket that's not covered with that stuff's going to get flagged. These are like the big ones that FHA picks up on. Smoke detectors and carbon monoxide detectors are covered by local codes. So not necessarily in Florida, but if you go to other parts of the country, you have to have smoke detectors and carbon monoxide detectors within a certain foot of each bedroom across the home. And it's a big pain in the ass. So thankfully you don't have to do it here. A firewall to the garage has to be intact, right? So if somebody goes through and they cut a hole in the wall to put in a pet door because they love their pet, that might create an issue at the end of the day. So this is stuff to keep an eye out for. If they do have air conditioning, it has to work. It doesn't require that they have air conditioning, but if it does have to be there, it has to actually function. Again, it's got to be functional, safe, sound, and sanitary. The roof cannot be leaking, and it has to have at least 2 years of economic life. Now that's become big in Florida with all the hurricanes and the insurance claims that have come through. So keep an eye on the roofs that are out there. You have to have at least 2 years of economic life, right? Now, if there's any sort of, and they put it as hazardous, environmental contaminants, noxious odors, noises, those are considered issues to the home. So the best way I can explain this is if someone has like a meth lab on the property, it's probably going to be a problem. Or if there's a chemical spill somewhere. Beyond that, you're probably not going to see a ton of these. But a big one that you do see is a trip hazard. So if your stairs are not the right height, or if the concrete in the driveway is off and people are walking up and tripping over it, it's most likely going to get flagged and be there for repair. So as agents, when you're taking your people out to look at homes and you know that they're an FHA buyer, these are things you got to keep on radar. If you're listing a home and you want to make sure it's going to pass for FHA appraisal as a seller, make sure these things are remediated and completed, or at least noted that, hey, this has to be done before you get on contract so that everyone's on the same page. Now, there are times when stuff like this gets called out by the appraiser and they have to go through it and they say, hey, you have to do repairs and you're already in process. They're then going to send out, have to send out someone to fix those things, whatever it may be, an electrician, a plumber, a painter, whatever. You're going to send them out there. They're going to fix the issues. They're going to send an invoice to the lender saying, hey, this was done. And then the appraiser has to go out there at a separate time and review it again to make sure that it actually is completed. Now, FHAs, it's black and white on a lot of issues, but sometimes it's kind of like art versus science. The appraiser has to make a good call to say, is this going to be a problem or not for the FHA? Because there's not really guidance on it at the end of the day. So some things you probably don't know about FHA appraisals. When you have an appraiser come out there, they're required to actually stick their head up and their shoulders in the attic and do an inspection. They're looking for certain issues in there at the end of the day. Again, hanging wire, exposed, if you're seeing daylight come through, you're seeing leaks, that's the stuff they have to actually physically get up there and look. The next one, if you've ever been to a home where the listing is a hoarder that lives there, the appraiser can't do their job if they can't see the floors and the walls because there's too much debris. They got to clean it out and make sure they can actually do an inspection of the property visually. Again, back to roofing, right? The FHA will accept a roof with at least 2 years of life left in it, but it can only have a maximum of 3 layers of existing roofing. So if you've had a roof redone and redone and redone, if it's going to go and it says, hey, there's a 4th layer, you're going to be stuck, right? If it's more than 2 layers, you got to repair it, and the old roofing must be removed, and they can't put on another layer. So that's another big one. At the end of the day, the FHA calls it like their whole enchilada. It's like every structure within the actual parcel of the land has to meet minimum property. So one that I ran into not too long ago, there was the standard home everyone was going to live in, and then there was a garage that was detached, and the garage had a broken window on it. And even though it has absolutely nothing to do with the home, the FHA still considers it because it's a safety issue, and it had to go out there and actually get repaired. So you have to look at the whole structure, what's on there. If there's ADUs, additional dwelling units, or other items that are on the property, you got to go through and make sure they also meet FHA standards. Now, there's no such thing in the FHA world for a certain feature of the property to be given 0 value. Like if a buyer and a seller agree that the garage I was talking about earlier is run down, it's not going to be included in the sale. That's not the way the appraiser looks at it. It still has to fit the guidelines. Okay, so these are stuff to look out for that a lot of people don't know about FHA. Here's a couple more that pop up all the time. Graffiti removal, right? If you go to a house and somebody's spray painting the house, it has to be removed. The FHA says it's got to get done. Now, pools are slightly different, right? The FHA typically will go, hey, whatever the local, city, county authority will say is cool for pool safety, we're good with that. There's no universal guidelines for the state. It all goes off local. But the pool does have to be filled because you can't run the equipment on the pool to make sure that it actually functions, which the FHA appraiser is going to have to do. If the pool's filled and it's green, you got to get somebody to come out there and shock it. That's going to be an issue. Just make sure you address that with your buyer and or seller up front, because it's got to get done. We talked about the pet door earlier. If you cut a hole in a firewall, that's a big issue for FHA. And then there's all kinds of other issues that are called subjective issues that appraisers can call out, but they're not necessarily required to call out, right? So there's a lot of unique homes out there. There's a lot of stuff that it's not cookie cutter anymore in today's market. So they basically say, hey, does the home work like it's supposed to, or the appliance work like it's supposed to? Is it a health and safety issue? And will it impact the marketability of the property? If those answers are, yes, it works. No, it's not a health issue. It's no, it's not going to affect it. The appraiser is most likely not going to call it out on FHA. So it gets a bad rap on FHA because they are tougher appraisals, but those are the main things that they actually look for. Those are the guidelines directly from an appraiser. So I know there was a ton of information. Anybody got any questions?
So I don't have a question, but I just want to chime in with all of these things that come up after the appraiser has come out there for the appraisal inspection. A lot of them are things that we can see walking through the home, and they may be things that your buyer is willing to accept, like chipping paint or something insignificant. But just remember that it may, or like an elevated concrete that, they don't want the whole concrete removed, but it still may get flagged. So don't forget about your FHA addendum. There is an opportunity for you to put a value in there for any repairs that kick back from the appraiser, so that you can pre-negotiate that, or at least set it up. Sorry about that. At least set it up so that the seller is aware that, listen, we may not have asked for these things in our due diligence because we're willing to accept it. But in the event that something comes back, then we'd like to negotiate that you will agree to so much in value on repairs. Do you have any comments about the FHA addendum?
Yeah, no, I think that is very high level. That is something that everybody should be doing because it prepares you for the inevitable. If you see it and then you're like, okay, it's going to get called out, a couple of things need to happen. It's got to be in the contract saying, hey, we place this much value on this repair, this, removal, whatever it may be, so that everyone is on the same page if it does get flagged. And then it also allows all parties to know, hey, if this does get flagged, we also need to make sure we have enough time on the contract to get this thing closed, right? If you don't know, tradesmen and tradeswomen in the market now are so overworked. It's getting somebody out there to do simple repairs can take a lot of time. So just make sure you prepare people. But what Angie went over at the beginning and putting it in the contract is 100% a great idea. And just make sure they're aware that some repairs might take longer than others, which may push the contract out at the end of the day. One thing I want to note too, there are two different things. There's an appraisal and there's an inspection, right? So there's multiple different inspections, but the appraisal is just to assess the value of the home and make sure there's no issues that are safety, sanitary, or soundness of the property. So two different things, and your inspections should turn up almost all of the things that are going to pop up on here as issues. Some of them need to be addressed, some of them don't. The point is to show you what ones have to be addressed and what ones don't necessarily have to. Sound good?
Yes, perfect. I think a
Awesome.
lot of times the buyers do get confused because I use the word appraisal inspection because it's an appraisal, but they're also checking for this list of stuff, right? So they are essentially kind of inspecting the property, right? So that could be confusing to the buyer. So just be clear on like inspection period, due diligence, and so forth. And then, what the differences are if they come up. Angie put, hold on, she just messaged me. Oh, never mind, something completely different. I apologize. I
That's
thought
okay.
she was trying to chime in. So
That's okay.
yes,
So yeah.
thank you for all the clarification on that.
Yep. So just so you know, if an appraiser comes out and calls something out that they're not a specialist in, that's where they're calling someone that is a specialist to come fix it. So they're going, hey, I'm just seeing that this is an issue. I've got to call somebody. They're not an inspector, right? They can't inspect for, if there's issues with the water, if there's, coliform, things in the water, they're not an inspector. They can't do, they have to pay a separate person, a separate service to do that. So an appraiser is just an appraiser. Your due diligence and your inspection period is a totally different thing. I just want to make sure everyone's on the same page for that. All right. Moving on to USDA, right? So USDA is relatively similar. There's a couple of things that USDA looks at when it comes to appraisers. First one is it has to be in a qualifying rural area. So USDA goes off a few different things. People will say farmland or they'll say RD, which is rural development. It's all the same thing. It means the government says, hey, this is considered farmland, this is considered rural development, and they have certain guidelines they put on that for qualifying for appraisals as well as for income and credit and things of that nature. But you have to fit in the area. It's got to be ruled as RD. If it's not zoned and ruled as RD, you can't use USDA in that particular area. So just like FHA, the house has to be structurally sound with a foundation and a roof in good repair that you can live in the house right away. So you got to be able to actually move in. You also have to be able to get to the house, right? There has to be accessed by either paved or weather road surfaced. And just like before, the heating, cooling systems, they've got to work again, right? It's got to be livable condition. The electrical and wiring have to be in good repair if there's exposed wires and fraying, or if it's not robust enough, if it's like knob and tube from, the 1800s that's in there and it doesn't work for the house, that might be an issue. The plumbing system has to work and the waste removal system's got to work also. So again, main stuff is it has to function as it says it's supposed to function. If it doesn't function that way, it's most likely going to present an issue where the appraiser has to call it out. A big one that we've seen where back in the day where they slap homes on properties and it's oftentimes manufactured modular or mobile homes, the well and septic systems are not 100 feet away from the house. It has to be 100 feet away from the house. I don't remember the reason why, but it does have to be 100 feet away from the house. If there's termite or wood-boring insect damage, that's going to present a problem, right? They're going to make sure that that's not the case. If you see boards that are crumbling in the home or a framework that's going bad, they're going to call that out and it's going to have to be repaired, or you back out of the contract and say this is way too much damage. A big one with USDA, because it's used for farming and usually big plots of land, the value of the home, no more than 30% of that can come from the land that's there. So if you buy a property that has, 50 acres on it and the property is worth $200,000, but the acreage is worth 170, it's not going to fly in USDA. It doesn't pass because there's not enough value from the actual home. You also can't use it to produce income. So you can have barns and silos and things like that on the property, but you can't have them actively working. Like if you go out there and there's a tractor in the backyard plowing a field and farming, that presents an issue for USDA. So you can't generate income for it. You can't have a business sign on your thing because it's a residence. USDA only does residence. So you can have these things on there, but they cannot be used for income generating purposes. Again, it has to fit with all the local zoning ordinances or have a granted legal exception from the zoning authority. You probably will run into this maybe once in your career, but you do have to fit in that box if there's there. Now, there can't be a pool, but if there is one, the appraiser can't assign any value to it, right? So if there's a pool there, it doesn't count towards the value of the home or the property. Along with that, you've got to make sure that all the things that are happening on the property, past, present, and current, all the repairs, build outs and everything, they're all set up to state, local, and building codes. It's got to fit what the actual code is for the area. So a big issue you run into on USDA is if you go with a modular home that's built offsite and pieces are transported together and put together, those are typically not built to state and local guidelines because they're built in a factory somewhere else. Sometimes that can present an issue because it's not set up to the building codes for the area that they're going to be in. All right. So when the appraiser looks at a home, right, they're going to look at a couple things. This goes for FHA as well and VA and conventional. They're determining the fair market of the value based on comps or comparable properties that have sold in the area. Now, the comps, you typically want to be homes that are within about a half a mile in most loan types, regardless, about a half a mile away from the subject property, and sales within the 6-month period of when the actual contract was signed. Sales that don't get recorded or things like cash sales or things that are out there that just are private sellers that are going through and not recording with the market. If you have appraisal issues where the comps don't come in, you can sometimes pull up those sales and send them to the appraiser as comps. But they look at certain things like the square footage, right? They're going to measure the home, make sure the square footage is actually right. Bedrooms, bathrooms, they're going to look at the condition of the home and they're going to look at, make sure it actually functions. A brand new home that was built a year ago versus a home that was 20 years ago, they're going to have significantly different conditions on the property for all of the major things like electrical, plumbing, the roof, right? It's going to look a lot different. So one home it might be the exact same builder, exact same cookie cutter home, but if they're 15, 20 years apart, the home condition does play into the actual comps that can be used because that wear and tear has to be accounted for. Again, you have to have access to the property, right? Got to have a paved road, all season roads. The USDA doesn't permit income generating structures. I can't say that again because this happens all the time. You can't have income generating structures on the property. Can't do it, right? And again, you got to meet all the local zoning and code compliance to make sure you fit within the local and state budgets for what that is. All right, before we move on to conventional, USDA is kind of a sticky one. You guys got any questions you want to go over for USDA?
I've never heard that they won't, I've never heard this, so I want to repeat it in case I'm the only one that caught it. There is no value for pools.
Correct.
None at all. Not a site built in ground pool, not an above ground pool, like nothing. There's no value, which is huge because a lot of times when you're, comping out a home as a listing agent, you're comping it out based on homes that have pools and you're adding $20,000 to $70,000 in value for that pool being there.
Correct.
So
if you look at, the second bullet point from the bottom, this is straight from USDA guidelines. I just rewrote it so it's in plain English so people can understand it. There can't be a pool. If there is a pool, it doesn't count as value. That's the simple answer for USDA.
Okay. Well, that's good for me just to highlight it for the others because I've never known that. So it's good.
I have never heard that either. Joe, this may be relevant for USDA, VA. It may be relevant for all of them, but I know it's definitely relevant for FHA. Mobile home specific, that they need the HUD certificate on the mobile home.
That is correct. Yes. So if you have a mobile home, they have to have the actual HUD tag that's on there. And unfortunately, people oftentimes remove those or rip them off, and finding a HUD tag and going back through that is a nightmare. So yes, mobile homes make it very difficult if the HUD tag is not on there. Thankfully, they got smart after like 20 years, 10 years, 20 years, and they started covering them. So where they're in an area where people can't really get to them, but people would remove them because they're an eyesore. And that's a big issue when you're trying to sell your house.
So does that apply for all the financing?
Yes, correct. If it's a mobile home, the HUD tag is basically, that's like the, what's the best way to describe it? That's like the registration on your vehicle. It's because it's a mobile home. It's basically a home on wheels. That's the registration saying, hey, it was made and built here and yada, yada, and it fit these guidelines. That's what that is.
And does anybody have any comments as to where that HUD tag is usually located? If you are a listing agent or a buyer's agent and you're wanting to kind of get ahead of everything, where would you look for that?
It's typically on the outside of the building, and it's going to be manufacturer specific. Unfortunately, there's not really a guideline as to where it goes. That may be different now. I don't do a ton of mobile home lending because they're just hard to lend on in general because they have to jump through so many hoops. But I can dig into that and see if I can get you guys more information. But as far as I know, from all the ones I've ever done, there's not a centralized location as to where they stick them. It's just, unfortunately, that's just not how they work.
I've always been told to specifically look inside of the door of the electric panel. Mm-hmm. Or under the kitchen sink.
Yep, those are the places they started moving them when they realized people were starting to take them down. It's not uncommon to find them on the outside of the home, but the newer ones, newer from the last probably 20 years, you will typically find them on an electrical panel underneath the sink or hidden behind a service like panel so that people don't take them off. But they're not in one set place, but those are good places to look. Coolio. So conventional is pretty straightforward. The guidelines and conditions are not the same as FHA. They're not the same as USDA. They're a little bit more forgiving when it comes to stuff. But one thing that the conventional does is they do rate a home C1 through C6. If it goes above a C3, you might be in some trouble with most lenders because I mean, it's not going to fit what their guidelines are and what their investors will take. But the resounding thing across the board is safety, soundness, and structural integrity or security in the property, right? Those are all things you keep hearing me say over and over and over. That's a running theme through all the different appraisal types, right? So one thing that I haven't gotten into, but I want to show you guys in these next few slides is if you have a conventional appraisal or a FHA appraisal or USDA appraisal, and it's listed as is, that means the appraiser came through and said, hey, there's no repairs that need to be done. It's good to go. This value is where it needs to be and we should be okay. If it's listed as subject to, that's where the appraiser has to hire a professional come out there and give some quotes as to what they need to do, right? It's an inspection by a qualified professional. Since they're not an expert in this area, they can't tell you exactly what it needs or how much it's going to cost for an immediate repair. And that's when we as agents and loan officers have to reach out to our network of people and say, all right, I need someone to come, do a mold test or remediate mold. Or I need someone to come out and fix the roof, replace some shingles, right? Fix the electrical or put some GFIs in or put a 50-cent plastic cover over it because they didn't put it on there, or if there's foundation issues because the foundation's crumbling, we've got to get in contact with all these people. So I only listed, I think 6 or 7 of them. There are multiple deficiencies that they can go ahead and list, and there's a link to it on there. If you click on it, it will tell you every single one. But again, if it's called out on the appraisal as subject to, they can't give you a value because it's subject to these things being corrected, right? All right, so what a conventional loan look for? Same stuff, guys. They want to make sure there's not termites tearing holes in it, dampness, abnormal settlement that's going to affect the value of the property or being able to sell it. They want to make sure that if there was work done on there are permits that were actually pulled that were correct. And then roof requirements, again, I keep going into this. If an appraiser notes that the roof leaks, there's shingles that are peeling up, or they're going to call somebody to actually come out and inspect the property to make sure it's either functional or what the repair is going to be. And that person comments on the overall quality. So this is where I say appraisers are not inspectors. They're trained to note things, but they're not going to tell you, hey, this is typically what you have to do or how much it's going to cost. So that's where you pay a inspector or a professional in that industry to do it, right? All right, so any questions on conventional? Conventional is pretty straightforward. I feel like people typically don't have a hard time, but any questions on conventional? Coolio. So we're gonna go into my favorite. This is VA appraisals. So how many people out there have heard that VA appraisals are the hardest appraisals? I know I can't see your hands and I probably can't hear you chime in, but there is a lending conference currently happening. And I'm supposed to be there, but I'm not there. But there's a lending conference on VA, and they just put out a statistic today. VA has the easiest appraisals to do. They come in at value at value or above value 92% of the time, and they come in value 7 to 8 days quicker than they do on any other loan type. So when people say appraisals are tougher, I want to show you guys why VA is way better, right? So first and foremost, any of those other appraisals that you saw, FHA, USDA, or conventional, if it doesn't come in at value, there is literally no process in place for any of those that's recognized by the government, which is the people who fund those loans at the end of the day, as to what you do when it comes in. So what typically happens if the value comes in low on any of those, you go through and you try and search out comps between yourself and the other agent on the file, and you go, hey, we need to supply some comps to try and bring the value in line with what the actual contract price we're looking for. Then you send it back to the appraiser who's already come out, done their job, gave you their value, printed the report and moved on. And you say, hey, I know you just did your job, but now you have to do it again. You have to do it for free. And we don't think you did your job very well. Now, in a perfect world, that wouldn't be an issue, but human beings are human beings, and people typically don't like being told that their job wasn't a good job and that we don't agree with it and having to go back and work for free. So the VA is the only process that is set up for helping with that if the appraisal doesn't come in at value. There's 2 processes for it. I'm going to walk you through both. The first one is Tidewater, and the second one is a reconsideration of value, or ROV. So here's the first process, Tidewater, right? So when you have an appraisal assigned through the VA, it's going to go directly to the VA, and they're going to contact a VA appraiser that's on their panel that's actually approved through the VA. That person is going to come back and say, hey, I just can't find a value that's going to match based off the comps I have. And they're going to send an email to whoever ordered the appraisal. Now that becomes important because if the lender has it's a large lender, let's say, and they have a appraisal department who just one person and their job is only just to order appraisals, the notification for Tidewater will go directly back to that person. And if that person doesn't know what to do with it, they've only got 48 hours to figure out what those comps are to turn them back into the appraiser to review it. If they don't do it within 48 hours, it's a dead deal, right? So make sure if you do enter into Tidewater that you know who ordered the appraiser, because that's where the email is going to come back saying, hey, it hasn't reached value. So he or she sends the email saying the value didn't come in yet. You've got 48 hours to turn in 3 comps, and that initiates Tidewater, right? So tapping 3, it's not going, hold on. So if you turn in these 3 comps and the appraiser says, hey, I just cannot get to the value after Tidewater's been there, we can't do it. That appraiser goes away and you never have to talk or speak to that person again. Then you go to the second phase, which is reconsideration of value, right? So the appraiser either has received the comps, doesn't support the price, receives the comps and doesn't support the purchase price, or no comps are provided. Anything's happened, you move on to reconsideration of value. This is where the VA has a person on staff called a SAR, where they review the appraisal outside of the appraiser. They have nothing to do with the appraiser anymore. And it goes to the VA, and the VA makes every effort possible to try and pull through and actually bring the value to where it needs to get to. I'm going to show you some statistics here, right? The way that this is done, the lender gets the appraisal back. It says the value is not there. You send a letter in writing from the veteran, which most good lenders that do VA loans will have a standard template where you can just fill in their names. They sign it. You send it over to the SAR. That's the staff appraisal reviewer. They work on the NOV. That's the notice of value, right? And at that point in time, the VA has a 15% automatic authority. So if the appraisal came in at $100,000, they can immediately move it to $115,000 if they thought it was justified. Now I'm going to give you a statistic that blew my mind. 98% of reconsideration of values are approved, but only 2% are actually sent in. It's because nobody knows what this process is or how to do it. So what happens in most cases with lenders that don't do VA loans well, they will do their loan, they'll get the appraisal, the guy will issue Tidewater, and nobody knows how to do the second part, which is a reconsideration of value. 98% of them are approved, but only 2% of the ones that get there that have the opportunity to do the ROV are actually sent in. So who you work with matters when it comes to VA for sure. So when you have a VA loan, you got to get the appraisal done. There are what's called MPRs, or minimum property requirements. All right, the basic ones, just like before, lead-based paint, it's a safety issue. Roofing, right? It's a safety issue. Heating, they want to make sure it actually functions like it's supposed to. If you're around high voltage electric lines, that's a safety issue. Those are things the VA calls out as MPRs, or minimum property requirements. Cosmetic repairs are not required, right? If updating a home is not required, yard work is not an MPR unless causing damage. I'm going to give you guys a perfect example. I do a lot of lending still in Michigan. It's where I'm from. And we have a home that a veteran was buying and had a basement. And so the basement had a bathroom in there. And the appraiser called out on there that, hey, the bathroom needs to have full electrical running down to the bathroom, a light switch, GFI interrupter, and everything else. And it was like, he said, hey, this has to get done. It was basically a remodel of the bathroom. We said, nope, that is not an MPR. It's not a safety issue. It's not an issue. We went directly to the VA. We turned it in and said, hey, the appraiser is saying this needs to get done for him to release and control the value of the home. The VA said, absolutely not. That's not required. They sent us an email in writing. We took it to the appraiser. Appraiser kicked rocks. The work did not have to be done, and we moved on, right? So again, knowing these things makes a huge difference for making it a great transaction for your clients. So you can request MPR waivers. That's what I was referring to before, right? It has to be approved by the VA, and you got to request it in writing. But as long as the property is habitable, safe, sound, and sanitary, you're good to go, right? The contributory value of waived items must be considered in an estimate of market value. So does anybody know what that means in plain English? If you're going through and you're asking for things to be waived, there has to be a market value attached to them so that the VA knows what the amount is that is being waived, right? One thing we see a lot of times is private road agreements, especially in Florida. If you're a veteran and you live on a private road, there either has to be an agreement in place with all the people that live on that road that they're going to pay for the maintenance of it. Or if that doesn't exist, the veteran can go to the VA or to us, and we can request it through the VA to do a property MPR waiver for the private road, saying the veteran understands that they would have to take on the responsibility for maintaining the road, and they have to give them a dollar amount of what it is. That's the market value. That's how that plays out. So you can do a ton of escrow repairs. There's no maximum dollar amount if things go sideways and things do actually need to be repaired that are MPRs, right? It can be paid by the seller, a veteran, or both. And repairs are held in escrow. They collect 1.5 times the amount of the bid from the contractor. So if it's, you've got to go through and you've got to replace a water system because the water system isn't there and they say it's going to cost $2,000, they're going to request that you put $3,000 into escrow because they want to make sure there's enough money to replace it. And that's it. You don't have to get multiple bids. You can get one bid, and it's 100% discretion on the lender. But the VA does allow 60 days post-closing for them to issue the loan guarantee. So if there's a repair that needs to be done, the lender says that's cool. The VA gives it up to 60 days for the repair to be completed. You just have to make sure those people check back in with the lender and say, hey, here's proof the repair was done, because it's something that has to go in the file for the VA. There's no seasonal restrictions, right? So if you're in Michigan, for instance, in the wintertime, if you found peeling paint on a property that was an MPR, you had to paint it. You can't paint it outside. It's not warm enough for the paint to actually seal. It's going to be liquid, right? So those will be seasonal restrictions. They say, hey, you've got 180 days or, to fix it up while the season's warm. There's no seasonal restrictions whatsoever at the VA, right? They're going to say you can do whatever you need to do as long as it gets done. So I realized that was a lot. Any questions on VA?
Joe, you have really been extremely thorough. I don't think I have a question, but 2 topic things that I wanted to address just from a realtor standpoint. Escrow repairs, also known as commonly to us realtors as escrow holdbacks.
Yeah.
So just kind of adding that terminology in there. And then when it comes to appraisals, and I wonder how much you'll agree to this, but my mentor taught me this, and we kind of roll it down the line when we onboard and mentor new agents. But if you're a listing agent and you're confident in your price and you want to be able to, kind of problem solve in advance, provide, and I find that the actual appraisers are a little bit more inviting to this than having to come back later. If you have strong comps, when the appraiser is going to be there, leave them or email them by any means. That's what I typically do. Hey, you're going to be there that day. Great. Can I email you my comps just in case you have different ones, yada, yada. I'm very graceful with it. I don't want to insult them, but sometimes providing that information up front. Now, it doesn't mean it won't still be a problem later. Maybe they don't agree with your comps because we're not appraisers, right? We're just looking for the best case scenario based on the guidelines given to us. But sometimes in advance, it's better to just provide that information up front. And even if you're a buyer's agent and the buyer is loving this house, they're comfortable with the contract price. I know sometimes as a buyer's agent, we're like, well, if the home comes in under value, then that really is protecting the buyer from overpaying, which is a great concept to think about. But also if they want it and they are willing, then fight for that and try and work with the listing agent and make sure the appraiser sees the value, just like you guys do. So those are just my only tips, but those are really just for realtors, not really commenting. But if you have anything or anybody else wants to add, please, now is the time to unmute, ask questions, or even speak about the process in general.
Yeah, no, I love that. I wish every agent did that. I have some that are good agents that do that. And I ask them to do that because if you think of it from a perspective of a human being, because again, appraisals are just human beings. If you're not a jerk about it, you're like, hey, these are the comps we want. They're not going to take them, right? You're like, hey, I just wanted to make sure I did this for my client to make sure we had a good value in a home. Here's the comps that we're seeing. And you just provide them and leave them, email them to them. Nobody in their right mind is going to get mad at you for giving them a hand at doing their job and making it easier. And the flip side of that is if you don't provide those comps and then the value comes in lower, you have to provide them anyways, right?
Yeah. And I'll tell you that there's a stigma that you can't be friends with the appraisers and that you can't have good, friendly relationships. When an appraiser calls me, I save their information in my phone. And if I happen to be there, I'm having conversations with them and I'm trying to be cordial and because if I have a question, I want to be able to feel like I can call an appraiser, even if it's not about a deal they're actually working, because obviously we can't communicate with them afterwards. But, just be friendly, be communicating with them. we're a team. Their goal usually is to try and make value if it's there. They're not trying to cut the market and keep transactions from happening. So, and you never know, after sale, you're going to be getting calls, likely if you're the listing and it's a unique comp or a unique property, you'll get calls later like, hey, can you tell me about that transaction? Pick up the phone, be friendly about it, because you never know when they're going to be appraising your next listing. So you want that good vibe.
No, I love that. I always tell my sellers, I'm like, look, treat the appraiser like Santa Claus, leave them milk and cookies and be nice to them. I'm like,
Absolutely.
if you are, they're again, I've said this like 4 times on here. They're human beings. They want to be treated like human beings. You may disagree on a value, because it is what it is. And appraisals are they're more art than science. They're more art than science. It's not, I mean, you can go into Lennar Homes and it's the same home 17 times over down the block. Those are pretty easy to appraise, but you're going to find all kinds of properties that don't fit the cookie cutter. And they have to adjust for things like square footage. And this one had a pool, this one didn't have a pool, this one's got this much wear and tear on it, this roof. There's a lot of parts that are moving on there. So if you just make their job easier, provide comps and be nice to them, it's amazing how quickly it goes and how much easier it goes.
Yes, I would definitely agree. And then also, Joe, I don't know if you know this, but we have appraisals in-house, appraisers in-house. Anita and Charlene's retired, of course. So they are great resources if you have questions, not to be abused, but if you have a question, or if you're having a hard property that you can't analyze and get listed and priced, don't forget to utilize our in-house appraisers or whatever. But Jesse, Angie, Tyra, I know you guys are on. Do you guys have any questions for Joe or comments?
Nope, I think it's great info, Joe. Thank you.
Yeah, if I can, you're welcome. Thank you guys for tuning in. If I can make one suggestion, if you're still looking at the screen that's either on your phone or on your computer, take a screenshot of it on your phone or take a picture of it. That's my contact information. I'm happy as hell to help you guys in anything you're working on. Even if it's not my deal and you guys get stuck, just give me a call. Angie will tell you I'm a resource. I like to be a resource to all my agents. I want to make sure we can get you guys stuff closed, even if it's not my deals, because that's the end of the end game is make sure you guys can actually do well and survive and be happy doing this and having an outlet for information, which I'm like as you probably saw, I'm a guideline, like just psychopath. I know all of it because I learned it over 20 years of doing this. So if you have a question, you have something you're not sure about, just give me a holler. And if you screenshot or take a picture, you guys can reach out whenever you want. And then on the flip side, if you do need help with someone to buy, the little QR code on the screen, if they just scan that with their phone, it takes them right to my app and they can get started. Super easy.
Okay, I didn't have any questions. I was just taking notes.
Thank you. Thank you. So he has also provided all of these slides. And like he said at the beginning, and a PDF. So I will email them out to the brokerage as a whole. So you can have them, you can print them, you can even bind them at the office and keep them on you. So that you can kind of predict what you're, memorize them and have them, in your storage banks of things when you're going to show properties. I know that I've had conversations with everyone that's on and probably more about like what you're looking for, especially if you have a FHA or a VA, what you're looking for specifically, and reminding the buyers that even if they're willing to accept it, it still may be a condition. It's the same thing we do with insurance right now. Like, well, just because the buyer is willing to accept the roof at a certain age doesn't mean the insurance will. Or like my condition with this particular transaction is just because the buyer didn't really care about the poly pipes, the insurance did, and we had to negotiate that. So it's always better to have the information and be able to solve the problem before it actually becomes a problem, or at least make your clients aware of what could potentially be a problem. So then when it does come up, they're really receiving and able, and they know that you're on top of the problem in advance. They know that you're going to be able to tackle it because you're aware and educated. So
yeah, 100%. If I can add to that, that's should be done in every file, but also loop your lender in on those stuff, because some of that stuff can make a direct impact on the approval and the loan types that are going to be available for you. It may not change the program from FHA to conventional or vice versa, but it may change what has to be done and what types of, again, insurance has to be picked up, what separate policies, who you can go with, when it can be bound, how much it costs. So there's a lot of moving parts on our end we don't really talk about, but this helps us do our job with you guys and make it a smoother transaction for everybody.
I agree. Well, thank you again, Joe. This actually worked out perfectly. The information you provided is far superior than what I would have been able to provide. So I really do appreciate the opportunity and encourage everybody to reach out to Joe with any questions.
Yeah, love it, guys. Thank you so much. Again, I'm happy to help. I would love to do more of these things. I like teaching. If you guys can't tell, I wrote this yesterday, so I like teaching. So
Yeah, and you're good at it. You do a good job. All right, everybody. Well, have a great Wednesday and a regular part of your week. I hope it's successful, and we will touch base next week.
happy hump day, Bam. Bye.
Bye.
Joe.